I've been reading the Wall Street Journal for years and years, and this is one of the most interesting, underreported aspects of kind of modern investing that I've seen in a long time. So here's the article, Why We Risk a Cartoon Version of Capitalism. It's an excellent article, but it definitely goes into the weeds a little bit. So really what it covers is how is passive investing kind of affecting the entire investment landscape, which happens to be the final project that I worked on during the FinTech course I took like 2 years ago, kind of coming out of COVID. So this is a little in the weeds. I want to kind of prep you for it by going over how we got to where we are and kind of the story and kind of the findings of that final project and some tie-ins to this great book, Naked Economics. So how did we get here? When modern investing in kind of public companies really started to take off, so we're talking like 1900 to let's say 1970, people decided what they were going to invest on based on which company they thought was going to do the best, which one had the most opportunity for growth, or which one was turning the best profit. This would cause their stock prices to go up or down, kind of proportionally to how well they were doing, was attracting how much investing. Then kind of fast forward, and people, as the investment landscape starts to really mature, people want to start understanding how well are my investments doing compared to, let's say, the average. And we start to get things like the Dow Jones Industrial Average, the S&P 500, and eventually the NASDAQ 100. These are indexes that measure kind of how the average of all the investments are doing. And then in the 70s and 80s, we start to get real kind of innovations in the investment space, things like the 401k and mutual funds that makes investing much more approachable for kind of normal people. They can invest very small amounts through their 401k, and they can invest kind of with the expertise of financial professionals through things like mutual funds. And we start to see that the average, let's say the S&P 500 for this video, it's pretty hard to do just as well as the average, and most investors are doing, kind of near the average. So the thought process starts to develop, well, if we're always measuring ourselves against the S&P 500 as kind of like that's what we want to do, then why don't we just invest in the S&P 500? And as technology and the investment landscape kind of continues to mature, now we're kind of in the late 90s, early 2000s, that becomes possible through index-based investments, where you can just put money into and buy blindly everything in the S&P 500, and it will, for the most part, give you the returns of the S&P 500. And we start to see that this becomes a very popular investment. And let's say in the beginning, 1% of people are investing passively. But they're investing in the S&P 500, and who determines what's in the S&P 500? Well, that's all the active investors. The rest of the market that's deciding who's doing well and who's doing not is deciding what is in the S&P 500. And to put it bluntly, the passive investors are effectively riding on the coattails of the active investors and just taking the average returns. Now, as the world continues to kind of develop, and we get to where we are now with low-cost ETFs and these kind of passive investments, the amount of money flowing into passive investments is dramatically larger. It's very contentious as to how much, but you're in the range of somewhere from 8 to 30% of investment volume goes into passive investments. And this article goes over all of the problems that are arising as so much of the world is not kind of actively involved in picking which company is doing well or not, or how they manage with things like voting, which I'm not going to go into, but the article covers very, very well. So the question arises, are we going to get to a point where so much of the investment volume is passively invested that the system is going to kind of fall apart? There are not going to be enough active investors to kind of ride the coattails of, which was the topic of this final project. And so I suppose during this that if being included in an index, allowed you to be passively invested in, then there would be some dramatic impact as companies entered or left the S&P 500. And we look back to, what had happened to companies that entered or left the S&P 500 going back like 40 years. And shockingly enough, throughout that, which was really, kind of the growth and heyday of passive investing, it actually, not only did they not get worse, it actually got better. Throughout this time, being included in or not in specific indexes actually had less of an impact on modern companies than it did, let's say, 30 to 40 years ago, which was surprising. So, how do you reconcile this, what's going on? Well, it really comes down to the efficient market theory, which was in negative economics. I mean, this is something that is pretty well known in the economics and investing world. What it says that is, if there's some way that you can make a profit, and you're making a much bigger profit than other people doing a similar exercise, then our economy is so efficient and large that people eventually figure out what you're doing and move into that because you're making more money than them. So they'll do it your way, and they will reduce your profits back down to kind of average. This is efficient market theory. So how does that apply to this situation? Well, the interesting thing about this is that as passive investors ride on the coattails of active investors and become more and more involved in, let's say, the S&P 500, then they're just blindly buying all the companies, which would imply that companies that are doing particularly well, which should be getting more investment volume than they are, will be undervalued. And companies that are not very good, that are just getting blindly invested into anyways, should be overvalued because they shouldn't be getting as much money as they are. So that creates a discrepancy between the value of the company and possibly their price, which active investors can capitalize on because they can see this discrepancy and make trades based on how they think they're going to perform. So now, as passive investors become more and more a part of the equation, they're not riding on the coattails of the active investors. They're creating a symbiotic relationship where passive investors are creating more opportunity for the fewer remaining active investors. They can make more profitable trades because passive investing is becoming so prevalent. This would imply that they will reach some type of an equilibrium where, as more and more people become passive investors, it makes active investing more attractive, passive investing less attractive, and we will eventually meet some equilibrium in the beginning, which I think is super, super interesting. Now, it does not address a lot of the other things that this article comes up around passive investing, which is very, very interesting. Now, if you like this idea of kind of misconceptions in the modern investing world, this is definitely the next video to watch. It goes into why the media is losing their mind over the Magnificent Seven, and really why they should not be. So check that out for sure. I hope this has been informative, and I will talk to you soon. Thank you.